AT&T credit spreads are very low, 85 basis points. There's a clear disconnect between how credit has performed since early 2017 and how equity has performed since early 2017. Credit spreads have been largely unchanged at 86 basis points, while AT&T equity has underperformed the S&P dramatically by 43%, including dividends. Year-to-date 2018, AT&T equity has been down 9%, while the S&P has been up 9%. This is a company that has a ton of debt on an adjusted basis, over 4 times leveraged. Since 2007, they have not grown organically. We've actually seen negative organic growth. They've added $125 billion worth of debt. They've acquired only $16 to $17 billion of EBITDA, largely through M&A. And there's just a ton of operating leverage. This is a very mature business. Revenues have been declining. If you look at the core wireless, wireline, and pay TV business, revenues have been down mid to high single digits for the last 3 to 5 years.
Does your theory rest?
And there's a lot of operating leverage.
Does your theory rest one way or the other at all on the transaction with Time Warner, or is that irrelevant to the way you're thinking about this?
That is separate. It does diversify the business overall, but having said that, I do believe that asset was sold at the top. Half of that business, Turner, is being disrupted as well as younger demographics. They're just consuming significantly less TV, anywhere from down 13% to down 45% since 2010. In terms of HBO and Warner Brothers, that's a good asset, but there is more competition. If you look at scripted originals like Game of Thrones, there's been roughly 487 scripted originals in 2017. That is 25% higher than 3 years ago. 85% of that increase is from competition such as Amazon, Netflix, and Hulu.
Do you think there's a higher margin business to be had in 5G when and if that gets rolled out?
I think that's very, very long term. This thesis is predicated on the fact that it's over 4 times levered. It's still rated investment grade. It's still perceived to be a risk-free asset, and revenues are declining, and there's a lot of operating leverage. Limited downside if we are wrong, but substantial upside if we are right. So that's cheap optionality.
And just to be clear, because we're running a banner at the bottom of the screen, the short case for AT&T, this is a short case on the credit side. Is this the same? Do you have the same view on the equity side?
This is a credit short. We think credit overall is overvalued. We think synthetic credit is also overvalued. This is a triple B or 1 notch above high yield name. If you get downgraded to high yield, you go from one investor base to another investor base. High yield overall is just a very weak market structurally. Over 40% of high yield is funded through daily liquidity vehicles such as ETFs and mutual funds. AT&T would be roughly 10% of the high yield market, and we don't think the high yield market could absorb this name.
Hey, Todd, it's Noah Blackstein here. Just a quick question for you. Is this a straight short, or are you pairing this against AAA government credit or something? Are you just trying to play the spread widening, or do you think this credit is going significantly lower and it's just a straight short, no pair?
Yeah, we view this as a straight short, just given the price. 86 basis points. There's limited downside if we are wrong. There's limited cost to carry if this takes 3 years versus 1 year. So we don't feel the need to pair that with a long on the other side.